Good day and welcome to the Cyient DLM Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishna Bodanapu, Non-Chairman of Cyient DLM Limited. Thank you, and over to you, sir.
Thank you very much. Good evening, ladies and gentlemen, and welcome to Cyient DLM Limited's first earnings call posting for Q1 of FY2024. My name is Krishna Bodanapu, and I'm the Non-Executive Chairman of Cyient DLM. Present with me on this call are Mr. Anthony Montalbano, the Chief Executive Officer of Cyient DLM, and Mr. Srinivas Kulkarni, the Chief Financial Officer of Cyient DLM. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in our investor update, which has been posted to our website. As you all know, Cyient DLM listed on 10th of July 2023. I want to take this opportunity to thank you all for your wonderful response to our IPO. Taking the company public is a significant step in shaping the future of design-led manufacturing, and it offers an opportunity for investors to join us in this journey. Over the past years, we have demonstrated Cyient DLM's capabilities in a wide range of EMS solutions and are well positioned to make the most of the favorable tailwinds in this industry. The combination of our design and engineering capabilities in Cyient Limited and our manufacturing capabilities in Cyient DLM Limited ensures that we're well positioned to meet our client needs and deliver value to them. I personally greatly value your trust and confidence, and I'm committed to holding same standards of governance and transparency that we have demonstrated in Cyient Limited. Lastly, on behalf of the Board of Directors, I want to thank the leadership team, especially the two leaders, Anthony and Srini, on this call, who made a seamless process transition from a fully owned subsidiary of Cyient to a publicly listed Cyient DLM. Once again, thank you for your interest in Cyient DLM, and I will now hand over the call to Anthony and Srini to walk you through the business update and financial performance. Anthony?
Great. Thank you, Krishna. Hello, ladies and gentlemen. Let me take you through the highlights of the quarter and business update. Yeah. So we posted a revenue of INR 2,121 million, which is 27% year-on-year growth. The major growth comes from industrial, defense, and aerospace segments. Our EBITDA is INR 200 million, which is a growth of 72.6% year-on-year. EBITDA margins are 9.2%, up 243 basis points on year-on-year terms. Profit after tax is at INR 4 million, down 15.2% year-on-year. This is primarily due to other income being higher in Q1 FY23, caused by unrealized forex gains. Cap margin is 2.5%, which is 126 BPS lower on year-over-year terms. Our order backlog is strong and stable at INR 24,997 million. And has an increase of 89% compared to last year. So as this is our first call, I'll take a few moments and cover the broadly business of Cyient DLM and our go-to-market focus before I move on to the key highlights of the quarter. So, when you look at DLM and how we differentiate in the EMS industry, it really comes down to the type of work we do and the sectors and types of designs we do it. So it's really mission critical, safety critical, electronics manufacturing services, primarily focused on aero and defense, medical and industrial segments. And so these are segments that clients require quality and capability and really a demonstrated track record to deliver these types of applications. We've been doing this for 30 years across 3 sites in India, and this has been a core of our business. The association as well with Cyient Limited and the 7,000 design engineers that we have available to us are also really a key differentiator for our business. They help us bring value to our clients through the types of services we can provide that impact manufacturing, and they also enable us to engage with relatively large multinational client base. Most of our clients are industry leaders, global in scale, and they gain the confidence of placing their business with Cyient DLM, despite our relatively small size as an EMS player, but it's primarily due to the track record we have, and then also the wherewithal of the larger science that brings that comfort. Let's go to the next slide. So, from a go-to-market perspective, as I covered, the 3 main sectors: air and defense, healthcare, and industrial. It comes down to the types of work that we're doing in these types of products. And in aerospace, we have products that are going, in aircraft. In healthcare, we will have electronics going into medical equipment, and then even in industrial, where it might not be a safety critical application, it's often called a mission critical application, where the reliability is very high for some of these units in remote locations that provide the service level that our clients need. So this has been a key area, and this is our focus as we walk through our operations. These are the types of products that run through our facilities, all in a low volume, high mix environment. So this is a very different segment of the EMS industry, which has very high quality process requirements to support these types of applications. Go to the next slide. So some highlights, for the quarter. First and foremost, we had a successful listing for Cyient DLM on the NSE and BSE, with a great response from the investor community. So this is something we're very grateful for, and this is a very notable point, for Cyient on its journey. We have a very strong pipeline of over $700 million. This is backed by major aerospace and defense clients, as well as some of the other sectors that we engage in. We believe that this will continue to convert, continue to drive the business growth that we have demonstrated in the business to date. We also recently were awarded a State Expert Excellence Award from the government of Karnataka. So this is a great recognition of the type of work we do, and then we also had some key customers' appreciation for some zero defects, literally zero PPM across some of our AEC segments. That is really a pretty high bar to try and reach, and that is something that we demonstrated this last quarter. We've also had some key wins that add to the pipeline. Some new wins in the aero and defense space, approaching $27 million. on one specific deal, and then also some other ones. We have other order intake of about 33.6 million during the quarter, providing stability to the backlog that we've already built. Next slide. So on the finance piece, I'm going to turn it over to Srinivas, and I can kind of do this.
Thank you, Anthony. Good evening, everyone. I'll walk you through the P&L and some key financial metrics. Our gross margin was significantly higher year-on-year basis. This is due to better revenue mix and a few one-offs we had in Q1 last year. Our full-year gross margins will be in the range similar to what you see in Q1. Our operating performance for the quarter was strong, and we ended up with an EBITDA of 20 crores, a growth of 22.6% on a YOY basis. Compared to Q1 of FY23, we incurred higher finance charges due to increase in borrowings and the interest rates. Also in Q1 last year, we had unrealized forex gains of nearly 8 crores. These two factors are contributing to 80 and YOY. But for the rest of the year, we should see significant increase in PAT. The strong operating performance will be aided by lower finance charges, the loan repayment we plan to do with the IPO proceeds, as well as higher other income we expect to see for the rest of the year. From a revenue perspective, aerospace and defense client mix is about 56%, followed by 30% from industrial, 10% is from medtech, and 4% is from others, which is primarily some work we do with rail transportation. The PCB box build and cable wire harness mix is in line with our historical trends. And from a export versus domestic mix perspective, approximately 70% of our business is in exports, and this includes deemed exports, and 30% from domestic. We don't expect significant change in this mix over the next 1 year. Our order book is very strong. It's stable for the past 3 quarters, despite doing nearly 750 crores of revenue in the last 9 months. A few of the orders repeat every quarter, while a few repeat every year. Hence, we may see fluctuation within the year. However, we expect to see growth in our order book on a clear basis. Our DIO for the quarter is 187 days, which is high. Now, this has to be looked at the customer advance days, which is the chart right below that, right, and which has also increased, right. So, customer advance sort of funds the higher inventory buildup. We plan to optimize this further, and we expect to see the number going down to about 30 days by the end of Q2 and 120 days by the end of the year. Our DSO also has increased to about 80 days in this quarter. However, there is no systemic issue or risk with any of our receivables, and some of the collections have come in after 30th June in the last 2 weeks. Therefore, end of quarter number is looking high. And also on some of these metrics, it makes sense to look at an average for the year, and we will continue to show the trend to you going forward. The IPO utilization, the IPO concluded only 10 days ago. We have still not utilized the IPO funds. However, going forward in this format, we will report the usage to you on a quarterly basis. Let me sort of close the presentation and open the floor for any Q&A that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wants to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment. Question to assemble. First question is from the line of Venkatesh Balasubramaniam from Axis Capital. Please go ahead.
Yeah, the question for Srinivas firstly. Now, when you are calculating your inventory days and payable days and sales days and customer advances, every denominator is sales only, right?
That is right, Venkatesh. This is exactly the definition that we have defined in our RHP. Definition gets used.
Okay. And you are using quarter-end number to calculate. You're not using any averages, correct?
No. Quarter-end number only.
Okay. Now, when you actually look at it, when you calculate net working capital, I am assuming that is equal to DSO plus DIO minus PO minus customer advances. But when I do that calculation, those numbers are not adding up.
So there will be some other current asset movement as well, Venkatesh, right? It's not a significant item, therefore we are not showing that.
Okay, understood. The other question which I had was, do you have a guidance for revenue, EBITDA for the current year and the year after? You would like to communicate revenue and EBITDA guidance.
So we don't want to give a guidance at this stage. What I'll say though is our revenue will be higher than the industry average for the year. We've also indicated what our order book is, and more than half of it is convertible in the next 12 months, right? So that sort of gives you an indication of what the growth can be. And EBITDA will be similar to what we did last year, that is between 10 and 11%.
Okay, 10 and 11% EBITDA margin. Now you mentioned that your revenue could be higher than EBITDA. Just to give you some information, Sirma has given a guidance of 35 to 40% for the current year. I think Keynes has a guidance of 50% plus the current year. So are you trying to say that you will do more than what? Because when you say more than industry, it's like quite open-ended. Because what exactly is industry for you?
I think Venkatesh, the industry is defined by other companies who are in the space as well. So for now, let's keep it at industry average or higher than industry average, which includes other companies in the EMS space. We will specifically not comment on any other company's numbers, right? So as we go through the year, when we have better confidence on the full year number, I think we will decide whether we want to give a or not. But for now, the order book is strong, and we expect to grow significantly, right? And so we would want to leave it there.
Okay. One last question from my side. I think post-COVID, your raw material or capital had actually gone up for almost like 1.5 years. Now, are you seeing improvements in terms of raw material orders, in terms of how fast you are getting? What you are seeing on this front when it comes to ordering of raw materials? Because that is one of the drivers of your working capital.
That is correct. Definitely the supply chain is easing out, but it's not easing out at the pace that we had expected originally. Therefore, while there will be a drop in our inventory days, it will not be a significant drop, right? So what we are saying is we will go down to about 120 days by end of Q2 and about 120 days by end of the year.
Okay. Thank you. All the very best for the next 9 months of the year.
Thank you, Venkatesh.
Thank you. The next question is from the line of Mihir Manohar from Concall Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity and congratulations on a good set of numbers. Sir, lastly, I want to understand the pipeline of $700 million that you have mentioned in aerospace defense. So, I mean, when you say a pipeline of $700 million, what do you exactly mean by that? Are it from existing customers or is it from new customers? Is it, I think, what is the visibility of the line? That is really helpful. And my second question was on the seasonality business. I mean, is there a seasonality in the business? I mean, does to put you form a major portion of the overall year? I mean, and why there is a seasonality? Just wanted to get an understanding around that. And what is the broader revenue split which happens across the quarters? That will be really helpful.
Yeah. Yes, Anthony, I can go ahead and speak to the pipeline. And the pipeline does, make up from current clients and also new clients as well. And, with a heavier weight on current. We do have some significant programs that we look to be announcing in the coming quarters that make up that have a material impact on that pipeline. So this is a view of where it is today, and as we close those deals and convert them, that pipeline may come down, and then of course we are also have our go-to-market initiatives where we can add on that. So we think this is a great base to take us forward. Right now our business view is we take a look at business from an annual perspective how we drive our growth. And we think this is the right pace to get us there.
Yeah, and on the seasonality, what we've observed in the last 3 years is H1 is about 45% and H2 is about 55%. We expect a similar trend this year as well.
Sure, that's it from my side.
Thank you. The next question is from the line of Renu Baid from IIF Securities. Please go ahead.
Yeah. Hi, good evening, team. I have two questions. The first question is, can you share some insights on the new customer additions that we have seen for our business, and any numbers or order values that you would want to assign with the new customer additions? I presume this would largely be in the non-aerospace portfolio.
Yeah, so I do have, in the past quarter, there is new customer, it does take a new customer addition. As far as the client names, we do keep, on a business award, we do keep that confidential, but what I can communicate is that it is along the same caliber when we talk about, an industry leader, similar to the type of logos that we've already communicated. So in our business, we will definitely add new clients, and we plan to show more awards with clients, new logos in that regard. The difference is that these will be, market leaders in their sectors. So from a business perspective, that drives our revenue, it's from a relatively small number of clients. We plan to add, we're talking adding new logos in the terms of maybe 4 or 5 logos a year is really kind of the way our business is run, and that would give us substantial growth. So it's very different than a company that might be, crossing many sectors and might have relatively smaller engagement and deal sizes where that's a bit of a higher client churn business.
Okay, but most of these new customer additions that you're seeing, including the ones that you already have, are you witnessing a visible shift in incremental volumes coming out of China to India? Or this would be more about the incremental volumes which the DLM is defined based on their positioning?
So on the clients, on the new logos for the past quarter, the specific case is really more of an expansion as the companies look at sourcing, they, many of these clients in the space are diversified into new geos, and India is becoming a top destination in that regard. So it's not necessarily business that's transferring from China, to India. It's basically new business award that now is really coming to India based on capabilities and the cost and the overall service level, which is allowing us to grow.
Sure. So my second question is, if you look at the broad exports, then we have almost had a business coming from exports. Any color you can share in terms of the geography between American, EMEA, APAC on the backlog or current scope that we have?
Yeah. Broadly, a good the number of clients we have, a good portion of that is for export. So a lot of our business, client-wise, our clients does go to Western countries, Europe, U.S., but some of we do have some larger local programs which will run through for the next couple of years. Some defense business directly within India. So today, that is picking up the largest share of our current revenues, but it's actually a relatively very small share of the number of clients we have. And we see that mix, changing a bit as we work through that. We see probably the exports will continue to make a greater portion of the overall business as we look out in the next couple of years.
Sure. And next is broadly, if you look at the working capital cycle in the last, as it comes to the last year's trends, clearly it is now inching close to 100 days. So this increase in the next cycle from a segment perspective or the end market perspective, do you think it is attributed to the textile segment where the growth has been highest, 75%, or it would be more in terms of securing the supply chain and electronic silicon in advance?
So let me address that. I think some of this is definitely due to securing the parts ahead of time to secure the revenue. But we see that easing out, and we have a line of sight to get to the working capital at 60 days by the end of the year. And so we are working towards that. Definitely DIO and DSO are major components that help us.
So what I'm trying to understand is the increasing share of industrial in a business mix, that also has an impact on the changing dynamics on your working capital cycle and overall ROE as well?
No, not really. I think that's not had much of a bearing. Some of the increases we see are actually in the aerospace and defense business.
Sure. And one last number to clarify, you mentioned approximately more than of your order book is convertible in the next 12 months. So does that imply this 4% of the 25 billion rupee order book?
So that's an executable order book. So of course, it will be subject to availability of parts and customer schedule push outs, etc. So that's a broad indication in terms of where the growth can be, but it's not necessarily that it will entirely be the growth for it.
Got it. Thanks much and all the best.
Thank you. The next question is from the line of Meet Jain from Motilal Oswal. Please go ahead.
Hello, thanks for the opportunity. So I want to just understand the mix of ODM and contract manufacturing part of our business. Like how much is ODM mix?
So we do not engage in any ODM type business, and just in terms of definition, when we say ODM, that means that we do not have we do not own the IP on the current revenue that we're shipping on. So this is really what I call pure contract design and contract manufacturing. Now we do programs for our clients where they will engage with us on design and manufacturing. And that's really on a build to spec application, and that's where instead of the client hiring, working with an engineering firm to get the product developed, and using a different manufacturer to get the product built. We have several programs where we do this all with the client, and this has enabled our Cyient DLM business, and also helps us bring value to our clients because we can leverage engineering.
Oh, okay, got it. And next is on the value chain of our business. Like we build box build and we do cable harnessing. So how have we moved our value chain and what kind of backward integrated are we?
Yeah, so I would kind of look at PCBA and box build is really kind of an offering to our clients, right? So clients will usually source those two together. So come to us, we'll do the electronics, we'll do the circuit cards, we'll build it into a box and ship that to them. Now there are cases where there might, for example, we have one large client where they have to have their own operation where they do the final assembly. We just do cards and we ship it to their operation and they do the box build. But most of it it's tied together on the manufacturing, CBAs and the box build. Usually that's sourced as kind of one business. And then you also have the cable and wire harnessing business, which is a little bit more separate, and some of the work that we do there is specific to aerospace, where we do some complex harness work in that regard, and that is an area that we do see some expansion in as we look forward.
Understood. And my last question is regarding our margin expansion phase. So are we doing any measures we are taking to expand our margin from current levels?
I'm sorry, can you repeat the question?
So I want to understand what are we doing to expand our margin from current levels? Like we are already doing some backward integration. We are integrating PCT and box builds to some of our customers. So apart from that, to improve our margins further and revenue growth, are we targeting certain sectors or certain products in the market going forward?
Yeah. Okay, got it. Yeah, good question. So, we have various initiatives that we do have in place that we are looking to expand on margin, right? And so just due to the growth that we've had in the business, we are getting some natural margin absorption, right? So where we are today, as we continue to scale and absorb costs, and along with some operational efficiencies, that alone give us 1-2 points of opportunity from an EBITDA perspective. And another area of margin expansion for us is really on these build to spec programs where we do the design and manufacturing. We have far more ownership of the overall product. We have far more input on the design, on the materials, control of the supply chain. And so these programs do allow us to make higher margins compared to a traditional standard, build to print business where the client controls all of that. So that can add, as that part of our portfolio grows, that can give us maybe another point to point and a half opportunity there on the overall business. So, as we look out a couple of years, there is an upside on margins where we could get 1, 2, 3 points as we exercise and deliver on those types of initiatives. And then we do have continual items that we look at, such as increasing our operation efficiencies and some of these just basically manufacturing best practices that we're always working on to improve upon.
Okay, got it. Thanks for the answer.
Thank you. A reminder to the participants, please press star and 1 to ask a question. Next question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hello, opportunity. Sir, sorry to repeat that point. Can you just repeat the guidance for networking part and inventory part, the schedule point properly, number properly? Please help me with that.
No, you want to know what the net working capital and inventory days are?
No, so I just want to know what is the guidance for the full year. You gave the guidance like, you want to reduce the inventory days as well as the cycle. So number that I didn't get the number.
So the inventory days we will go down from 187 to about 100 days in Q2 and about 120 days by end of the year.
Okay. And regarding networking capital,
which is at 98 days right now, will go down to about 60 days by end of the year.
60 days. Thanks for clarification, sir. One second question from my side. Look, the trend of the customer advances, it's very volatile. There are days we are getting. What is the reason for volatility in the customer advances?
So the customer advance, so I didn't follow your question. Can you say that again, please?
What's the reason for the volatility in the number of customer advances? Because I assume all the client will be giving us orders to execute the order. What is the reason for volatility in numbers? Because revenues have gone up, but the number of days has come down.
Yeah, so the customer advance days are very specific negotiations that we do. Not all customers gives us advance. A number of times, customer is himself asking us to order the part ahead of time to secure the supply so that the revenues are not disturbed or his supply is not disturbed. In those instances, we go and renegotiate from a contract which is already in place. So it can fluctuate depending on the specific negotiation that we have with the customer or the request that comes from the customer. I think it's best to see that number in relation to DIO. Right? So whenever you see the DIO number, you should that customer advance days, that number is basically where that's the right guidance.
So last question from Mike. In order to execute, in order to grow at higher rate than the industry of 30% growth, the industry has been estimated the industry will grow in the RHP also more than 30%. So I just want to know what is the kind of order book that we are expecting to grow in the coming quarters? Growth of the order book.
Yeah, so order book we will see growth. It's hard to predict how much the order book will grow by, because a few orders repeat on a quarterly basis, a few repeat on an annual basis. What we see is a significant pipeline on which we are working on. We also see the total contract value of the awards given to us right, significantly high. And it's almost 2x of the current order book that we see. So it's very, very hard to predict. Definitely, we will see a growing trend in the order book, right? And that's what we should look out for. The order book is also dependent on customer-specific practices. There are certain customers who give a firm purchase order and give an award letter and then give a purchase order only for a specific period of time, etc. So we have to look at all these things together to get a view of what the growth is likely to be.
Okay, sir. That's it from my side. Thank you. All the best.
Thank you. Next question, the last question from the line of Bobby Chen in Investments. Please go ahead.
The current weak environment, how is that impacting your business?
So the sectors that we engage in are at this time not seeing really any weakness as far as their end demand. Again, our main focus is aero and defense, medical and industrial, and so there's it's a little bit different of a volatility that compared to what you might find in a sector that's more consumer based or maybe like automotive where it's concerned about weakness in the economy, buying patterns might change. So right now we're these sectors that we're in on the aero side, it has more of these long cycles, and right now it's very much come out of a down cycle and accelerating into the beginning of an up cycle. And the medical and industrial piece, again, we're not seeing much weakness in those sectors when we speak to our clients.
Okay, got it. And given the emphasis India is placing in its defense industry, do you see the India part of the business going faster than the global one?
Which part of the business? Could you repeat that?
The Indian defense part, given the emphasis the Indian government is now placing in the defense part, do you see that part of the business going faster than the global one, or is there no difference?
So I don't have a direct answer as to the growth rate of the Indian defense compared to the global business. I can comment though that is an area where we see a lot of opportunity. So we have a lot of business in that sector today, and it's an area that if we choose and chance on it in that regard. So as far as an opportunity perspective, that business has pretty strong opportunities, right? So we, just even in the last 2 weeks, there's a couple things that we've already had that, on that sector. There's different aspects to India defense compared to maybe like other types of business where this might have higher ROCE because of the ability to turn inventory on that type of business, maybe get more client cash advances. But that business is more competitive and also can yield a little bit lower margin compared to our other business. So it comes down to having the right balance to hit the objectives of the business.
Right. At this point, our growth is not coming because of that. It's
correct.
Other things that are driving.
Sorry, I didn't get that. Your growth is not?
Yeah, sorry. Krishna was just providing a clarification that our growth is not our growth and even our pipeline is not based on the defense.
Okay. Right. Got it. And when you expect any new business from any of your existing clients or new clients, is there a certain ROE metric that you look for or a certain margin that you look for? How do you access new business?
So, for us, the measure of a business is really those metrics, right there. And so it comes down to the type of work that we do. And so, as far as the profitability, margin, guidance that Srinivas provided earlier in the call, that's where we're operating now. That's kind of the baseline, and that's what we see going forward. The ROE or the ROC on the business, right now for us will be a bit lower, especially since we had cash come in due to the IPO. But our target is to get ROCE up into the 20-25% range for our overall business, and that'll probably take us probably a couple of years to get to that range.
Right. So, as investors, should we be looking at margins, operating margins, or ROCE?
That is a debated question. I think one thing I would point towards is if you look at the PE ratios across the EMS industry, and you look at the companies that have been operating for decades, the companies with the highest PE ratios are usually the ones that is directly correlated to the bottom line. We think there's a healthy balance, right? So, are you creating more business value by saying, hey, I'm only going to go after 13 to 15% business and limit your growth, maybe have your ROCE suffer, or do you move purely into, high volume consumer business, which is low single digit profitability, but takes very little cash. It has high inventory turns, and it's a different type of model. So, we operate in the high end of that sector. We operate in the higher margin side of that, and that gives us a high bottom line. But there is a little bit of a trade-off on the ROCE, and I think there is a case made on potentially down the road to look at a little bit of trade-off on ROCE versus the bottom line. But our strategy right now is pretty much continuing on the really on the order book we have, on the pipeline we have, which is based off our core sectors today, which should give a similar type.
So more bottom line focus.
Yeah, I would say definitely more bottom line, especially for a company like Cyient DLM.
Right. Okay. All right. Thank you very much.
My pleasure.
Thank you. Ladies and gentlemen, that was our last question for today. I now hand the conference back to the management for closing comments. Thank you, and over to you.
Thank you very much. Thanks for being here this evening. Obviously, this is the first first investor call for Cyient DLM, and we look forward to showcasing the business a lot more and having these conversations at least quarterly going forward. As we've done with Cyient in the past, we will plan to also host an investor day for Cyient DLM Investors Show, so we can actually showcase, and as you know, in this case, there's a lot more to showcase, our manufacturing facilities and capabilities, and we will keep you posted on that. With that, thank you very much, and speak to you next time.
Thank you very much. Ladies and gentlemen, on behalf of Cyient DLM, that concludes today's call. Thank you all for joining us, and you may now